Hey, everybody. Welcome back to Investing Unscripted, where we ask and answer the hard questions about investing. I'm Jason Hall, diehard Atlanta Braves fan. My Braves have won the first two games against the voice of the people, Jeff Santoro's Mets. But the voice of the people, you're not here to talk about how your Mets are the inferior team this week. You have another reason to be here.
Yeah, but you know I can't not take that bait. So, couple things.
Totally bait. Absolutely
Mets are
bait.
Significantly better than the Braves so far this year, but every team goes through these bad stretches. The Mets are in one right now, but we'll see where this shakes out at the end.
Okay, fine. Well, we'll continue this conversation throughout the summer and into the fall, hopefully. We do have a great show planned beyond me poking at you about our sporting interests. We have a wonderful guest, and it's a bonus for listeners because you get guests 2 weeks in a row. And as we all know, guests means hearing less of me and you, right, Jeff?
Yes. Every time we have another person on, the percentage that we talk is significantly less. And that's especially true for you, which is the real win. So we have with us today, Alex Morris, who is a second-time podcast guest. But in the time since he was first on, he has written a book. So we will talk a lot about that. But let's welcome him in here first. Alex, welcome. Happy to have you here.
Thank you for having me. I have some comments already. Well, first of all, I'm a Cleveland Guardians fan, and we're struggling at the moment, so I'm going to pass on talking about our team, but I will note that I am wearing a Florida Panthers shirt, which you can't see that well, but we did just win the Stanley Cup, and some people would say that's more important than the Mets, and I can't remember the other team series. That's how unimportant that one is.
Wow.
It's true. No, it's true. When any team you follow wins a championship, that's the top story.
That's it.
I agree with you.
Yeah.
I agree with you.
Yeah, there's went a long time without doing anything, so it's been a nice run. When I was in high school, my buddies and I, we would go for... People would be handing us tickets as we were walking in. That's how uninterested people were in going to the games. And now it's $100 a park. Things have changed in the last, well, I'm not going to date myself, but things have changed.
Well, congratulations on your win.
Yes, we'll take it.
Let's talk about the book, Buffett and Munger Unscripted, 3 Decades of Investment and Business Insights from the Berkshire Hathaway Annual Shareholder Meeting. So my first question, Alex, is I noticed the name of the book is Buffett and Munger Unscripted. And I just want to know, maybe there was a miscommunication. We've yet to receive a royalty check for using unscripted in the title of your book, which I can only assume was inspired by your fandom of our podcast. So it's fine. We can take the royalties later. That's cool. But congratulations on the book. We both own it. I'm enjoying reading it. I'm a couple hundred pages in. And I say I'm a couple hundred pages in because this is my first question for you. How did you get to deciding to come up with this idea for a book? Because it's a thick book with tiny words. No, I mean, not tiny words, like tiny font. So it's a lot. So it must have taken like a long time to compile. And it's an interesting, I'll let you pitch it and tell everyone what it is, but it's unique. And I'm just curious, like how you got to the point of deciding this was the book you wanted to write.
Yeah, well, first, I've yet to receive a payment of any type from the publisher. So I hope that's coming at some point in time.
Oh, so that's where our royalty check is. That's fine. Okay.
So your royalty check will shortly after I get that. And I also promised to give away half of the proceeds to Glide, which is a charity that Warren's supported for a couple decades, which felt like the right thing to do at the time and still feels like the right thing to do. But it was also a lot of work, and I forgot about your cut of the book proceeds. So
you know what? We'll give up half of our cut also.
Yeah.
Perfect. Okay.
Yeah. I think that's the right
like that.
Yeah.
But no, the inspiration for the book was going back to when I first started investing. I really got into this because of the Berkshire Hathaway shareholder letters, and also because of Larry Cunningham's book about the Berkshire Hathaway shareholder letters, which is, for those who don't know, it's just a really digestible version of the letters broken down into certain topics. And it's not even the breakdown in my mind in terms of like the ease of consumption as much as the continuity of how things are framed and presented that is super helpful. As I get into this book, I think a very prominent example is something like Geico competing with Progressive in auto insurance. And just knowing generally what's going on is useful, but when you see Warren talking about it year after year after year after year, it presents it in such a different light that is similar to me. That's how that book hit me. So anyways, fast forward over time, the Berkshire meetings had always been in person. There was no video recording, which for people like us sucked, because unless you could go, then you just had to hope that you could find some notes and that they were accurate and all that jazz. So in 2018, when they announced that they were releasing the videos back to 1994, like it immediately clicked then that, well, one, this is hugely valuable. And there's definitely an opportunity to do something with this. What exactly that would be and how much time it would take probably stalled me a bit. at the start, but as a little bit of time went on, and as I was able to build a transcript, and as I started using it for a lot of TSOH, like investment philosophy articles, which it's funny, those feel like those hit at least more broadly, maybe for like the dive-hard investing people, maybe it's not as much as like a deep dive or things like that, but it definitely can go a lot broader in terms of the audience interest in those type of write-ups. So anyways, as I did that long enough, I thought I'm kind of already doing this anyways in terms of going through and listening and organizing a bit. Maybe I should try to basically do this version of the shareholder letters book, but for the meetings. So around that time, got in contact with the publisher. And as I told them, I was like, I'm not going to commit to this unless Berkshire says it's okay. I don't even know if that'd be legal to do since it's a lot of quotes. But even if it was legal to do, I'm not doing this unless they're basically like giving it, not their blessing, whatever that term would be.
Agreeing not to sue you for doing it.
That's the term. Yes. Yes. So when they wrote back, then I was like, okay, now I have to do this basically. So yeah, from there it was another 2 or 3. I mean, I kind of been working on it already, but it was 2 or 3 years of like serious work from there to get it all to the finish line.
So before your book came out, Alex, I actually started going back and reading some of the letters that are on the website. So this was great to have this additional context, right? Because that's just the letters. It's not what they say in the meetings. One of the questions I had was, as you wrote this book, I mean, I'm sure you had a preformed opinion of Berkshire Hathaway and Warren Buffett and Charlie Munger. And I'm just curious, like, as you went through the multi-year process of compiling all this stuff that they said from the 1994 meeting through now, did it change substantially in any way the way you thought about them as investors or Berkshire as a company, or maybe even the way you think about investing?
I would say mostly no. I mean, it certainly, some beliefs that I already had, I think, became more intensified, I guess the word would be. The characterization of him being folksy, like that type of thing. I get what it means to some extent. There is some truth to where that's coming from. I'm sure particularly the earlier days, you can find plenty of examples. But in terms of their interactions with people and how they go so far out of their way to be sure that they're not doing anything that's anywhere close to being offsides is kind of amazing. And this goes back to, I remember the one meeting when they were discussing the issuance of the Class B shares and how much time was spent at that meeting addressing every possible question that people had about what was going on. Just everything about the way that they deal with stuff like that is the level of integrity and the level of consistency over time in terms of how they think and have acted is fascinating. I think also in terms of intensified beliefs, I think I appreciate more than I probably did even a couple of years ago how much importance Warren places on the level of certainty in a business's economics as he looks out 3, 5, 10 years, and then the capital allocation component behind that of the investment, which he can really clearly control for wholly owned businesses through incentive structures. It's a lot different at publicly traded companies. And I think when you start thinking through that lens, you look at investments like PetroChina, IBM, Apple. Besides the valuation, one huge part of each of those 3 investments is clarity on what the capital allocation priorities were going to be. And I think Oxy is very similar. So it's just something that consistently comes through. And again, obviously in a public company, his ability to influence the decision-making is a lot different than it is at a wholly owned subsidiary. But that part shines through more to me than it did 8 and 5 years ago.
And that's interesting to me because when you hear commentary about Buffett, Munger, and Berkshire and what they think about when they buy stocks, you hear people talk about they don't want to overpay, 15 times earnings, right? You hear all these numbers thrown around. You don't hear that aspect as much, but I agree. Like I said, I'm 100-something pages in, and even in that little bit that I've gotten through in the book, I noticed the same thing, just like a constant emphasis placed on that aspect of it. So that's interesting.
And you can't be, I know people make a huge distinction between these two things, and there is some distinction between these two things, especially mentally, but the purchase decision on an equity and the holding at different valuations decision on an equity is not too dissimilar at the end of the day. And my favorite example is something like Coca-Cola, where you can't buy a stock and make it a very large position in your portfolio, which it was for Berkshire during the 90s and early 2000s. Never buy or sell a single share for more than 3 decades. If you're someone who is intensely focused on valuations and running expected IRRs across a portfolio of securities and adjusting weightings based on, you can't operate, you would never operate in that way if that's the way that you thought about the world. And there are other considerations, taxes and other things, so he's on the board of directors, blah, blah, blah. But point being, it's overstated at times where that falls into the equation. Very important, but other pieces are also very, very important.
One of the things I'd like to talk about is some of the observations I've made following Buffett so closely for as long as I have, and going back in history and reading letters, the same process you went through to create this book, to look for, I don't want to say patterns or trends or anything like that, but to try to really distill down how has Buffett evolved, but also as he has become a more and more distilled version of himself as an investor, what are the things that stand out? And a couple of things that kind of jump out to me I'd like to hear your thoughts on is the one that I think maybe he doesn't get enough credit for, and that's mental flexibility. I want to give some examples through history of that. So the first time Buffett ever really wrote about airlines was to say that, to paraphrase, the investor class would have been better off if somebody had have shot the Wright brothers down, right? And then made investments in the airline industry. Of course, then the pandemic happened and the whole thesis was blown up, and he made a change there. But it's exemplary of somebody who's willing to change their mind about industries. Apple, of course, is the ultimate example of figuring out how to value something that in the past he didn't really know how to value very well. And maybe that a lot of that was less his evolution and more of tech companies evolving from spending lots of money to try to find some sort of an edge. And it's always a race to the bottom to building the moat of Apple with its brand, right? So maybe that's less about Warren and more about Apple's evolution. And then we can look at things like dividends. He's been pretty steadfast about, for Berkshire to start paying a dividend is surrendering, right? But loves companies that pay dividends and has written glowingly about that. Swore that they would never split the stock. The B shares were basically a stock split. Swore he would never use stock to buy other companies, has used it. So always being willing to reevaluate every side of a thing and then act based on the information in front of him. Now, I'm just curious, some of the observations of reading so many of the source materials and your thoughts on that.
No, I completely agree. I mean, I think it speaks to, I think it's what I was trying to say before, effectively, that the thing that they're only actually dogmatic about is anything that'll be perceived as them taking advantage of shareholders or cheating at the game. They're dogmatic about never buying Microsoft because he's really good friends. Like, those are the types of things that he's dogmatic about. Everything else is, and again, even, something like dividends, you dig in and with what he says about dividends, and he has rules for or ways of thinking about whether or not it makes sense to pay a dividend, right? As opposed to paying dividends is dumb or something along those lines. It's a much more thoughtful explanation of his views. And by the way, to your point on him liking companies that pay dividends, I think it goes back to what I was saying a moment ago in terms of he is very wary of what the alternative capital allocation uses would be for the companies that do not adhere to those. Right. Someone who has followed and invested in a lot of companies now, I appreciate more and more why he thinks that way. He's pretty smart about this stuff. Surprise, surprise.
Yeah, it's funny, right? We learn over time that a lot of times the people that run the businesses that we love, they're just really good at running those businesses, and they're really crappy investors. They don't know when their stock is cheap or expensive, and they're bad at acquisitions. And when they get big enough to pay a dividend, that's taking risk off the table of them doing something stupid with our money.
Yeah, as he said before, a lot of times the skill set that gets somebody from middle of the org to CEO does not necessarily correspond with capital allocation. What's the example? You used to become the head of the Philharmonic or whatever it's called, and then you got to run the Fed or something. It's like, it just doesn't translate.
Yeah.
Right. There's numerous examples like that. I mean, the airlines, he's been in them in some capacity on maybe 3 different occasions now. And
never done well.
It was a significant investment. The railroads were an industry that has a lot of similarities probably to how the airlines, what he was probably thinking about when he invested in the airlines most recently. And the railroads went through a similar process in the early 2000s. And like anything, I think they're always open to thinking about things differently as the facts change, which is it's a good way to go through life.
When I was on vacation about a year ago, I read the book about Charlie Munger.
Poor Charlie's Almanac.
Thank you. Poor Charlie's Almanac. And I'm finding myself having the same thought when I read through your book, which is that I had when I read that one last summer, which is every time I read about Berkshire, Buffett, Munger, I have all these thoughts running through my head like, yes, that's right. I should do that. I agree. That's correct. And it gets me thinking, how much do you think individual retail investors like me should really take from the wisdom that they give out at these meetings? And do you think there's any way that people, or any part of it that individual investors should just ignore as far as it pertains to their own investing? I'll give you an example. I read your book and I think to myself, I should own 3 stocks. I should own 3 stocks that I know really well and have high conviction in. And when I feel like I have high conviction, I should put all my money into those 3 stocks because they talk so much about diversification is for people who don't understand what they're doing. And you should only swing at the fat pitches. But when you do, you should swing hard. There's all these. And I know the context in which they're saying that. They're saying like, this is the way we view the world with this enormous company with billions of dollars. But I worry that individual investors go out and they learn the wrong lessons, right? They do the too literal thing that I'm just saying to be funny. Like they decide, well, Buffett and Munger say I should have a concentrated portfolio, so I'm going to have a concentrated portfolio. And Buffett and Munger say, when I know I'm right, I should put all my chips in. And then they blow themselves up. So I'm just curious, like how you think, as someone who spends so much time reading and thinking about with their advice, like, do you think it can steer regular old folks wrong?
Yeah, I think it surely can. I think you need to, I think you could probably, it might not be the best example in the world, but if you took the Bible or some book like that people generally perceive as helpful and useful, you could take some things too literally, and your use for the book might be very different than it might be otherwise.
I stopped stoning people a long time ago. I learned that lesson.
It takes a little while, but eventually you learn that. No, but I think investing is a game where there's your ability and willingness to bear risk is a hugely important part of what you do at a very high level, even asset allocation. But then even when you drill down into an investment philosophy, it has to be something that's aligned with what you're trying to achieve, what you're comfortable with, where you think your skill set may lie, et cetera. And the answer to that question is going to have a lot of influence on how you then apply. I think the learnings are still applicable. The way that you apply them is worth thinking about. And again, I always come at this now from the perspective of less so right-wrong investment approach, and as opposed to trade-offs. There's trade-offs with every approach, mine and any other. The exact opposite of my approach. There's trade-offs with both of them. And you got to figure out what that looks like for you. But yeah, it's funny. I think of someone like my dad, who's a really smart guy, smarter than me. And he's of the mindset, like if I had $5 million, I just wouldn't invest any of it. Why would I need to invest it? Even if I had a 30-year time horizon, why would I need to invest it? I have enough money. It's all I need. And for someone like me, like that drives me crazy, but it's a different way of thinking about risk and that part of the equation. Again, like that's not right or wrong. It's just a kind of personal preference. So if you're going to invest based on somebody else's preferences and way of thinking about the game, you're eventually going to run into a place where you're going to find out that was not a good idea.
Yeah, I think it's a common mistake that I think a lot of investors make, particularly early in the continuum of trying to figure yourself out, is you try to stuff yourself in somebody else's form. You try to do it how somebody else that was successful was. And I think, to me, one of the great examples of one of my favorite things about investing in stock picking is that it's one of those things that there's a lot of ways to do it and be very successful that can really work well. 2 of the most popular investors of the past 40 years, Warren Buffett and Peter Lynch. And Peter Lynch took a very, very different approach. And one could say maybe a harder approach too, because when you're running a fund, mutual fund, you're investing other people's money, right? So you're totally subject to the whims of people wanting redemptions and all that kind of thing. But at any one given time, there were 300 or 400 stocks in Magellan when he was running it versus this ultra concentrated portfolio with Berkshire now that the top 5 stocks probably make up, 70% of the portfolio? I mean, it's a substantial amount. So very, very different approaches. And over that same period of time, the Magellan Fund essentially did about as well as Berkshire did. Just an extraordinary, extraordinary track record of results. So I think that's a big takeaway that I hope people is learn the lessons that apply to you, right?
Yeah.
It's funny you mentioned him. So you got specifically asked about Peter Lynch at one of the meetings, and he said, basically there's more than one way to get to heaven. And I don't think Peter Lynch would have been as successful if he tried to emulate my approach, and I wouldn't have been as successful if I tried to emulate his approach. They were uniquely suited for those approaches for one reason or another.
Yeah, I think the way I land on this is I try to just stick all of their wisdom in my brain to be accessed later when I feel like it might be the right time. But I think that's how everyone ends up being as an investor, right? Like the investor you are at the end of your investing life is probably, whether you realize it or not, a conglomeration of all the different investors you've come across throughout your life, right? Who've changed the way you think about this thing or added a different piece to your process or introduced a factor when making a decision that you should take into consideration. I think that's the way probably to take all this and not just, like you said, try to do it the way someone else does.
Yeah. You don't want to get to the place where, hopefully I wasn't doing this a decade ago. Maybe I was, hopefully I'll go back and delete some tweets, but you don't want to be out there like tweeting, be greedy with others or fearful because you're buying some company at stock. It's figuring out how to take these ideas and appreciate them and then apply them intelligently versus using them as like some defense for whatever you wanted to do anyway. Or you could do that if you want to be able to cherry pick quotes, but it doesn't really do anything for
you. Don't use it as a justification for the choice you want to make. Right. Exactly.
Yeah, right. Exactly. No, that's exactly right. All right, Alex, let's go back in time a little bit. About 6 weeks or so ago, we're in Berkshire. We're in Omaha. The three of us are standing there. There was Tyler Crow was with us, a couple of other folks that we know, and we're talking. And right there, standing next to a pool table, I'm drinking a fairly mediocre Manhattan. And the good thing was that who bought that Manhattan for me, Jeff?
Jack Dorsey.
Pat Dorsey. Pat Dorsey. Yeah. So Pat Dorsey bought it for me. He doesn't know he did. Yeah. A lot of people
he's
think
he's a listener, though, so now he knows.
There you go. But Alex, we were talking about one of the catalysts for coming this year was that it really felt like time was running out for Buffett to continue calling the shots. And we didn't know if he was going to be around at any future meetings, and we wanted to make sure to be there. You made a prediction. You predicted that was going to be his last meeting as CEO. So here's my question for you. Did you find out something when you were getting permission from them that you
inside knowledge?
Yeah, I traded on that information. There's a Kawashi or whatever it's called had a market on the retirement. I made a lot of money on that one.
We know what the next 6 months is going to look like. Buffett's running the business day to day. We've seen a decade of transitions of other things already have been shifted off of Buffett's plates and onto other people's plates already, right? So this is not a binary. The switch is going to flip January 1 and everything Buffett's ever done is going to go to one other person. We've seen that transition already happen. But I do want to take it to, and I don't want this to sound morbid, but at some point, Buffett's no longer going to be with us. A year from now, assuming he's still alive, he's going to still be chairman of the board, so substantial influence on the business. And even assuming that he does retire as chairman, I'm of the belief that he probably dies in that role because it's easier to make that transition than it is the CEO. But let's just assume he retires as chairman and he's still alive. He still has massive influence, right? At some point, Warren Buffett's no longer with us. What changes when that day comes?
Yeah, I should know real quick, when I made that prediction, it was being a good value investor. It was just me growing more confident, confirmation bias, because I had made the comment on Andrew Walker's podcast. So I was doubling down and sticking with my prediction with no incremental evidence to support that belief.
I mean, look, if you're right, it's an epic call. So I think you did the right thing. You stuck with it.
Absolutely. Yeah. Nobody notices the one you miss if you get one really big one right.
Yeah. Whatever the opposite of catching a falling knife is, I did it on that one. No, it's funny. I think, obviously the annual meeting is the big event where everybody comes together and it's a big part of Berkshire, but it's obviously not a meaningful part of actually running the company or its operations. And from that perspective, I think you zoom out in some ways and go, I mean, this has been true for some time and has become more true over time, that Warren's role and his importance in that process has continued to diminish over time. Honestly, with the level of cash that's been built up on the balance sheet and the lack of meaningful investments, equities or otherwise, in the last handful of years, maybe decade plus at this point, close to a decade.
Yeah. I mean, you can go back to, with the exception of Oxy, and even that one's not massive. You could go back to before the pandemic. The biggest investments during the pandemic were selling the airlines and the investments in the Japanese trading companies.
Right.
Which are less than $10 billion combined.
Yes. So, I mean, I think it really points to the biggest thing that honestly, in some ways probably should be changing now and will need to change going forward. That leash will go away. And the rationale for holding very significant excess cash is people are going to press a little bit harder. I can't remember which meeting it's from in the book, either 16 or 18, 2016, 2018, something like that, where it says basically if I come back to you 5 years from now and the cash balance is much larger than it is today, that's not okay. It's not reasonable. And we ended up there anyways.
Right.
It's a huge problem. I mean, the company is so big and the cash that's thrown off is so massive that they need to find a different answer than the current answers. And that's true with or without Warren. It's much more difficult to defend your answers without Warren sitting there, obviously. And he's pretty good at finding good answers anyway. So there isn't much left to defend.
Buffett's been very canny. We can go back, I guess, the past two meetings, especially as that cash pile has grown. Warren has wrote more words about the virtues of cash than I've ever expected. And it's true because not only the operating business is throwing off cash and the dividends that they're earning, but the cash is throwing off cash now too because of where yields are.
But it's true though. They just thinking about the amount of times they talk about the cash pile through what I'm reading in the book, and it's always, we don't like it. We wish it wasn't the case. Yeah. We just can't find a better, if we have a lot of cash, it means we haven't found a better idea. Trust me, I wish we did have a better idea. Like that's the vibe all the time. But it is funny when you watch the numbers that they cite, because it's the 95 meeting or the 2001 meeting or the 2016 meeting. And then you think about how much cash there is now, and they're going like, yeah, I can't see it getting much higher than 30, and here we are 10x that.
Right. And I think one of the things, it's kind of a funny historical, Warren has certain things, at least from my perspective, that he just didn't particularly want to do. He much enjoyed going out and buying businesses and growing Berkshire than he did doing repurchases, as an example. And he gave justifications over time why repurchases wouldn't make sense at any given point in time. Notably, he would say, hey, when the market's down 40% and our stock's down 30, there'll be other things that are more true. So he'd always use like a rationalization like that, which is fine. It can be true. I think he just generally probably didn't want to do it anyways. And then Berkshire probably got started a bit too late in terms of doing that, which they now have the problem of being so successful and so large. It's a good problem to have. But yeah, I just think, unless we're going to wake up one day and Greg's going to be shaking hands with someone in a photo op for a $60 billion deal, which that could happen. That could be the direction that Berkshire goes. I think people are probably, especially if it's a publicly traded company, if it's an equity investment, people are going to just have some questions and it's going to feel different, right? And I don't even know if he has any interest in doing that. And I don't know if Todd and Ted are going to be given the leeway to do that, or if they have the interest in doing that either. It's just kind of up in the air for now. And I think the most plausible answer to me is something that looks like a more typical corporate capital allocation policy, or they come out at some point in time and just start doing special dividends periodically. That makes the most sense to me. And I really view it as the most significant problem, unless I'm misunderstanding or not thinking clearly about the incentives of the people at the operating businesses. I don't really buy the Warren Buffett's the CEO. So I know I'm 65 and really wealthy, but I want to continue running, Fruit of the Loom. Like I don't really buy that. I think that person probably enjoys working to some extent and will be in the role whether Warren's here or not. Maybe there's a few outliers that I'm not thinking of.
Honestly, those outliers, though, they're Buffett's age and approaching it. Pete Legel, right? That was an example. He was running the business he founded and sold, that he negotiated directly with Warren to sell to Berkshire and wanted to keep running it. And he had a hell of a comp plan along the way, too. He made $100,000 salary, and then above like a certain threshold of earnings, he got 10% of the profits of the entire business, right? So there aren't many of those left, right? Because most of the acquisitions that we've seen over the past couple of decades were big publicly traded companies, or like a Duracell, which was a unit of a publicly traded company, right? So why don't they just buy Adobe, and that solves half the cash problem right there?
Here's the other thing that I wonder, and I like what you just said, Alex, that if I understood you correctly, basically the whole philosophy around buying companies might just change or have to change when it's not Warren making the decision. Because the piece of it I keep wondering is, walking into a room to make a deal with Warren Buffett, no matter how much he says Greg Abel's the guy, it's going to be very different when you walk into a room with Greg
Abel still in the room
to make a deal, right?
Yeah.
You're walking into a dude who's not Warren Buffett, right? So it's just a different, so I think, I don't want to say it's like an aura, but there's no way that transaction goes down the same way when it's someone other than the actual person of Warren Buffett. So there just might not be as many deals to be had, or maybe the terms are a little less favorable, or there's a little less leverage that Berkshire has to deploy because they're not dealing directly with Warren Buffett. So I kind of like that way of thinking about it. Like maybe they just need to think differently writ large about the capital allocation plan, and it's just going to be a new chapter. I think that's an interesting way to think about it.
Yeah, I don't disagree. My two thoughts are, well, one, those rooms and those deals basically aren't happening right now anyways, whether that's for lack of
anywhere
to see eye to eye on price or whatever. Those deals aren't happening with Warren. And even to the extent that with Greg or the future management team, if that number decreases by some percentage, I'm thinking of in my head right now, MRKL acquiring Costa Farms. It's the largest grower of ornamental plants in the US. And I was listening to the CEO of Costa as I've been going through an update on MRKL. And basically the guy is saying, it was a family-owned business. And when I talked to people about selling to these guys and got to know them, they are not a private, and this all sounds very similar to Berkshire, right? They're not a private equity firm, maybe long-term owners. And the one interview I'm watching with him, he said, honestly, MRKL is more patient capital than the capital that I had when my family members were fellow owners with me. Well, for someone like that, again, to the extent that they walk into a room with Greg and still have the assurance that this is going to be the same sort of structure that it has been, and they're finding a permanent home and they're going to be able to run the business as they have, as long as that's the case, and especially as you're talking about numbers measured in billions or tens of billions of dollars, they may wish that Warren was in that room, but they're not going to have many other rooms to walk into to go pitch that deal to someone. I think it kind of cuts both ways. But I just think at the end of the day, the bigger issue is there's not enough supply of these things anyways. Even if there was, it's hard to continue to do this for another 10, 20, 50 years. It's just not going to work, I don't think.
Hey, everybody, we'll be right back. But first, a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on around 1,800 stocks. So for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes.
Hey listeners, my name is Brett Schaefer, one of the hosts of the Chit Chat Stocks podcast. On our show, we do comprehensive stock research reports, interview analysts, and learn from great investors. And we have coverage on stocks like Airbnb, Nubank, Mercado Libre, and many others. Plus, we cover all the hot financial news on our weekly investing power hours. We have episodes for all types of investors, and think if you listen to this podcast, you will enjoy ours as well. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts, and start discovering new investments today.
So I have a follow-up to that because this is something I've wondered, and you mentioned MRKL, and that's what got me thinking about it. I've always found it curious that there's never really been a successful copycat of Berkshire. And maybe it's not fair to say like a success in the sense of like the size it gets to and a capital allocator like Buffett, but it doesn't seem like there's that many businesses out there that are even trying to replicate something like what Buffett and Munger built. And I always wondered if that's because people just view it as like a stodgy way of investing that's no fun and they don't want to do that, or if it's harder than it looks. But they do give you a nice roadmap. Like, here's this book you wrote of all these little nuggets of wisdom and ways they see the world. I mean, I know it's not like the actual, here's the secret formula for when we're looking at intrinsic value or anything like that. But do you think like a company like MRKL is like are they an example of like maybe the closest thing we have out there that is similar to a Berkshire Hathaway? Why do you think it is that we haven't seen like a really successful copycat?
Yeah, I think it really requires the right ingredients. One is a long time, and another is a really, really smart person at the top, or a really, really smart group of people at the top, which obviously Warren and Charlie are basically singular in terms of that kind of standard. And then as part of those things, it requires the right ownership structure, right? In terms of, especially if it's a public company, obviously, it needs these pieces in a way that can be sustainable over time. That is really, really, really difficult to do for a company that is got to wherever it's at now, having not followed that playbook to then try to make that switch. So then the alternative is starting to do that from scratch when you're a $10 million company, or whatever it may be.
And then we'll know in 60 years if it worked.
Then it's going to take a long, long, long time to get there. And MRKL as an example of trying to replicate that structure, and they've had their own challenges in insurance in the last handful of years. But I think generally speaking, they have the right mindset in terms of flexibility of capital allocation priorities. And one thing I do like, speaking to the example earlier, is they've implemented repurchases now in a way that I think is really beneficial, to the extent that they're successful long term, is a really nice kind of pressure release valve at times to help deal with the issue of if you compound at 10, 12, 15% a year, where you're going to get to in terms of your size as you look to your time frame, decades down the road, right? But yeah, I just think it's the starting conditions to get there are incredibly difficult. And I think to the extent others have tried to do it, there's a few names like that we probably mentioned, and they're generally smaller or they just eventually realize this is a really daunting challenge to even try to do this. And if you're a CEO of any normal corporation and you got there in the ways that we described before, why in the world would you try to start doing something like this versus very, very narrowly focusing on what everybody else is doing, basically?
And you probably wouldn't even be able to do it if you wanted to, right? There'd be activist investors or a board that doesn't agree with you or something.
Yeah, I made the example when I read about MRKL, and there has to be a limit to this, but you go look at the wholly owned businesses in Berkshire after MRKL is about 20 years into the MRKL Ventures wholly owned businesses experiment, for lack of a better term. They're kind of at the start of the game in a lot of ways. Like I think they had to learn a lot over time, and they were at a size where what they could go after was of a certain nature, and they've really stepped on the gas in the last handful of years in some of the deals they've done. But if you look at compared to a Berkshire owned in the 90s, from where we sit today, you would look at the list of businesses on there and be like, what the heck are these things?
Right.
Seas Candies, you would be like, where are these companies now inside of Berkshire? Are they 5% of the asset value of the corporation even? So I just think it's a natural part of that kind of evolution and getting to a certain size that it's just really, really difficult, I think.
Here's a question. I want to ask this with a little bit of nuance. The Buffett or Munger kind of idea, I definitely identify a lot more with Munger personally and what he's done in his style and kind of his approach to life versus Buffett. The question is, thinking about the whole of Berkshire and the success of Berkshire, do you think Buffett gets too much credit, and or another way to think about the same question, Munger maybe doesn't get enough credit? How do you think about that? If you're giving credit to what Berkshire has been, how do you think about responsibility and credit?
I think my sense would be that generally speaking, how they, especially amongst the people who, not just the general public, let's say people like us or even people who are a little less diehard than we are, I think they're probably kind of appropriately considered. But I mean that mostly in terms of probably like time commitment and spent Warren sitting on the phone with the G chain and what that's meant to Berkshire over decades. I obviously have no idea how to quantify that, but even him coming to work at Berkshire or going through the conversations of a number of deals, obviously, that didn't get completed and then all the deals that have over time. Like, I think Warren's really the one that has probably taken the vast majority of that effort on. I'm sure Charlie has on it.
Done the work, right? No,
Yeah.
I think that's fair.
He's the one sitting there doing the work and taking the phone calls, and I think probably to a disproportionate level relative to Charlie. That said, I can't remember if it's Todd or Ted now, but he basically was the one who brought him in. And that's where the contact came through. And so I think there's probably a little bit of that as well. But Warren strikes me as the one that was really spending a lot of hours every week building this thing, whereas I identify more Charlie as well because he seems like he was relaxing a little bit more and doing other things.
So he's funny as hell.
Yeah.
He's so funny.
I kind of wonder, I mean, this is to your point too, because Buffett is investing and understanding businesses is his life passion. It is his pursuit in life. And I can only imagine that there's probably like somewhere deep inside of his psyche, a part of him that like regretted having to do the annual meeting because that was a Saturday afternoon that he wasn't reading proxy statements and annual reports, right? So, and that's the difference. And I can't remember who it was. I think it was one of the Chit Chat guys, Jeff, that said that Charlie was obviously the smarter one because he found Warren Buffett to invest his money, right? And do the work. And on that same Saturday where Buffett's reading annual reports, he's studying Roman architecture. That was Munger being that far more well-rounded kind of consumer of knowledge and information about the world. So I think directionally you're right, Alex. My only caveat is, and this is the thing that I'll always wonder about, is Warren is the one that was putting in the work, particularly really once we get kind of into the late 80s and forward. Warren was doing the bulk of the work. But is the quality of the work that he's put in as he evolved under Munger's influence more valuable than it would have been before? Like, how much more valuable is it? And that's unanswerable to some degree, I guess, right?
Sure. I think especially as you go and try to bucket the really big decisions. I think Geico ultimately happens either way, and it's largely Warren's doing. See's Candy, there's a famous story of as they're trying to get the deal done, Charlie went and talked to one of the key gentlemen involved in the See's family side of the equation. So you talk for an hour about the joys of women, wine, and something else to convince him that he shouldn't spend his life dealing with the stupid candy company. He should just sell it to them. So maybe he was influential on that deal. And as they've said many times, Coca-Cola probably doesn't happen without See's Candy. So it depends how you attribute some of these things between them.
I would add this too. This could also be chalked up to one of their levels of one of them having a higher level of humility than the other. But you often hear Buffett credit Charlie for changing his thinking on dozens of things. And you never really hear Charlie credit Warren for changing his thinking on anything. That's one thing.
Yeah, I mean, Charlie's known for saying, you're smart and I'm right.
Right. But here's the other thing too. We also, I don't know that we give enough credit to the fact that being a CEO of any company is a lot of things, but it's also being the face of the company and just being a little bit more sarcastic and acerbic and likely to say offensive things. I don't think you'd see the success in the company had Charlie Munger been the face of it, running the meetings. One thing I've noticed in the book is, I don't know if I could quantify this, but the proportion of Buffett words to Munger words is probably somewhere like 70-30 in favor of Buffett. I think about when Buffett had to testify in Congress. I'm sure it happened more than once, but after Salomon Brothers, right?
Yeah.
Like who writes the annual letter and that the folksy nature of it. I've read a lot of what both of them have written, and not that Munger's a bad writer by any means, but it's a different vibe, right? It's a lot more, I'm right, this is the way you should view the world, and Munger's just a little bit more, Buffett's a little more sanding off the edges a little bit. So I think that's an aspect of it too. I firmly believe they'd be nowhere close to where they are without both of them being there. That influence and that relationship, I'm sure, was part of the secret sauce. But yeah, I think I agree with both of you that if you had to pick one of them as being the bulk of the success, I would lean towards Buffett as well.
I think part of the way to say it too is building Berkshire Hathaway and making it what it is today was a goal for Warren, and to some extent, or to a major extent. And I highly doubt it was like really a goal for Charlie. And a great example of them in action talking about some of this stuff is in the 90s in one of the meetings in the book. They're talking about the silver trade that Warren was doing around that time. And Charlie says something like, Warren spends all the time doing all these things that basically don't matter at all. At the end of the day, it's just these 3, 4, 5 decisions that's all I really focus my time and attention on, is he's running off and doing all this other stuff. And to your point, Jeff, I think there's a lot of it that in hindsight, not that these were the biggest deals in the world, but who's getting the phone calls during the financial crisis? I don't know. Warren is getting these calls. And I don't think that's because of their titles at Berkshire Hathaway, or was because of their titles at Berkshire Hathaway. It's because of what you're saying. He was the face of the company. He was the person who you'd reach out to if you wanted to do that deal. So both hugely influential, obviously, though.
Yeah, absolutely. Alex, you were first on our podcast in October of 2023. So we encourage everyone to go back and check out that to hear a little bit more about your background and the science of hitting. But as we hit the end here, we do want to give you a chance we've been talking about the book for an hour, so I hope everyone is excited to go buy that and check that out. But give us the elevator pitch on the science of hitting, where people can connect with you and find all the great stuff you do.
Sure. I was an equities analyst for about 10 years after I graduated from college. And I also was writing online for that entire period as well. So my background is somewhere between an analyst and kind of a writer, a researcher. And when 2021 came around, I'd been doing that for a long time, but working at RIAs, and there were parts of my role that don't fit great into an RIA. It's a bit more of an asset management and financial planning business, which is fine, but it's just a bit outside of what I kind of truly wanted to do. So I saw what some other people were doing, like Scuttle Blurb and MBI and, Ben Thompson, Stratechery, and thought maybe I can go direct to people and start a subscription research business. So launched in 2021. Thankfully, it's going pretty well. My pitch is basically I'm an outsourced equities analyst. I send research to people every Monday and every other Thursday. That's deep dives, philosophy discussions, updates on current holdings and watchlist names. Anytime I make any changes in my portfolio, disclose it to people before I do so. Then on a quarterly basis, update returns. So yeah, I basically work on behalf of subscribers, and to the extent they need anything from me, they can always reach out. But that's my full-time gig now. It's been fun. Sometimes wake up and I go, crap, I have nothing to write for next Monday. I need a bigger something.
I think every writer feels that way.
We're doing a podcast too. You're like, what exactly are we going to talk about today?
That's how we start almost all of our planning meetings, actually.
Which are typically 48 hours before our recording time.
If we're good, they're 48 hours before.
Yeah, that's true.
That's no problem. I found something to plug in every time, so hopefully that continues.
I want to encourage people to check out The Science of Hitting. It's a great product, deep research, and your value roots show. So it's a great, I think, not just as an idea service, but also for a jumping off for people that want to figure out how to be better as when it comes to analyzing stocks and finding opportunities. The price of that service is a hell of a lot cheaper than you would pay to try to go to school for finance and walk away with something that works a lot less effectively in the real investing world. So I would encourage people to check that out. We'll have the link in the show notes.
I appreciate that. Thank you. Yeah, I always say it's if the research is good, which I've worked my butt off to produce good research, then it's very, very underpriced. If the alternative is true, then it would be overvalued at $50 a year. So hopefully it's going to work. I certainly work as hard as I can to make it worthwhile for people.
Alex, thanks again for coming on. This was a great conversation. I'm sure we'll see you in these parts again sometime.
Thank you, guys. I'll be listening. And by the way, you teased a couple episodes ago about a gift for people who are on the Patreon. I've been checking my mailbox every day. I haven't seen anything yet, but I'm sure ittle show up any day now.
As soon as we get our royalty check, you'll get your gift, Alex. How about that?
Oh, I forgot about that already.
Well played. So what Alex is talking about, go to patreon.com/investingpod, and you can find our newsletter, episodes of the podcast. But there's a $5 a month paid plan, $60 a year. It's pretty cheap money. You can get access to a few things. One that you get access to is limited ad versions of our podcast, exclusive rough cuts at least once a month, which are fun. Jeff uses grown-up words occasionally on that.
Occasionally.
And also what's become my favorite part is our Discord server. It's exclusive Discord server where there's a lot of members already in there, and we're having a lot of fun conversations, making fun of Cena and his love of sailboats, and even talking about investing too. So check that out. It's pretty fun. And Alex, I've got an idea for that gift. We'll see if it happens though.
I'm excited. Any day now, I'm sure it'll show up.
There you go. Jeff, we done? Is that it?
Wrap us up.
All right, everybody. Thanks so much for listening. As always, we love to give our answers to these hard investing questions, have people smarter and better than us like Alex come on to give their answers as well. Remember, our answers are not necessarily your answers. It's up to you to figure out the right moves in your portfolio to find your own investing decisions and answers. You can do it. I believe in you. All right, Jeff, we'll see you next time.
See you next time.